But one of the things is that we also have an inverted yield curve where short-term rates are paying more than long-term rates, but that's really a difficult scenario for an investor when they're looking at retirement income.
Absolutely, and part of what I talk about, and obviously that is one of the risks, is all-time low interest rate environment. It is kind of setting the perspective of historical rates. I mean, today's retiree probably remembers the 70s and 80s, right? That's why we keep saying we're at low interest rates, because we lived the paradigm of
The Jimmy Carter era,
yeah,
right?
Absolutely.
I was there for that.
It wasn't so great when you had to get a mortgage.
Right.
But it was good in terms of yields for savers. But if you actually look back, you go back 100, 150, 200 years before that period, it was pretty consistent that yields were in the 3 to 4% range. So our perspective may not match what we think more long term. And now with the 10-year Treasury approaching 3, we're kind of at a spot where I don't know how much they're going to go up more. I mean, yeah, we've recovered from 1.5% and 1.7%, and it seems amazing that we can be up at 3, right? But 3 to 4 is kind of that long-term paradigm that we're there. So if you're still now in a spot mentally thinking, I want rates to go higher, I get it, that's the 70s and 80s, but I don't know if that's the future of where the economy is going to show.
And I think one of the solutions as we take a look at, so what does the investor do?
Yeah.
I mean, there's so much noise, but one of the things that I really like to focus in on for people for their fixed income portion of their portfolio are the fixed indexed annuities. And one of the challenges is there's so much noise out there on annuities, and there are some really bad annuities out there that have really extremely high fees. But in the case of the fixed index annuity, you can actually find annuities that have no fees that give you a great upside of the market with market protection.
Right, and to the point on noise, you got noise on annuities, but you also have the noise on fixed income yields. Interestingly enough, what you read about in the Fed and on all the finance channels is more short-term interest rates.
Right.
Right, like what the Fed is going to do. That's not what a fixed income investor is looking at. Is a 30-year Treasury, right, or 30-day Treasury. That's short-term rates. We're talking more long-term, 5 or 10 years, how you want to invest. And exactly, you'll actually see a lot of information right now. It's coming out how in an annuity or the right annuity can be a very strong bond alternative. And because of the fixed income nature of how an annuity is built, and we've done shows on how insurance companies price them, and not all annuities are built the same and all this stuff, but the right annuity could be an absolutely great fit as a fixed income alternative, at either to the bond, a CD, or maybe that's money sitting in cash, which is absolutely doing nothing right now.
It's really nice to shift your assets as you're looking for fixed income to CD replacement, I would call money markets, bonds.
Alternatives,
It's
fixed income alternatives.
And that's
right?
actually how I've been working with a lot of my investors here over the last 5 to 6 years, is let's just take a look at that portion of your portfolio.
Right, and that's, again, there's so many different products and so many different carriers and so many things when you encompass just the word annuity. I think the biggest thing just comes down to education about matching the right product for your right objective.